And there's only two assets that outperform the debasement of currency. And I've talked about this ad infinitum. And that is technology stocks and crypto. And crypto is the fastest horse in the race. Why don't fuck this up is because neither of those two assets are particularly easy to own because they're volatile. They want and people hate them. People whisper in your ear all day long. They mock you on Twitter. They tell you you're stupid. You shouldn't do this. You shouldn't do this. Buy my value investing stock. You should buy the Russell 2000. You should diversify, my friend. And meanwhile, we've got probably two cycles left to not fuck this up. Again, apologize for all the swearing, but this is actually important.
Raoul Pal delves into the intricate terrain of the evolving digital economy, placing a strong emphasis on the transformative impact of cryptocurrencies such as Bitcoin, Ethereum, and Solana. He vividly describes this emerging economic landscape as a network of interconnected nation-states, each possessing unique attributes and systems. Within this digital realm, he underscores the importance of interoperable systems like Polkadot, Quant, and Chainlink, drawing parallels to the traditional concept of border crossing. These systems facilitate seamless interaction and integration among the diverse digital entities. Shifting his focus to the broader financial markets, Pal provides insights into the dynamics of bond yields, inflation, and economic growth. He highlights the impending challenges faced by banks, particularly regional ones, as they grapple with the necessity to offload commercial real estate assets due to mounting debt burdens. Additionally, he underscores the looming need for quantitative easing measures in response to these challenges.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
It's really interesting when you think of it in economic terms. These are economies. This is a digital economy of crypto land that has other states within it, Bitcoin, Ethereum, Solana, whatever it may be. So that becomes very interesting. And you can think of, even within that, you've got, interoperable systems, stuff like whether it's Polkadot or Quant or a whole bunch of these things or Chainlink, interoperability. That's the travel, the border crossing from going from one of these nation states to another. We've got immigration, which is us opening wallets. We've got FDI, which is VC. We've got trade deals, which is hot money flows chasing opportunities within a country, which is the ETF. We have a monetary system. We have interest rate systems, which is the yields. We have a collateral system. You can call that Bitcoin. You could even call ETH collateral within the system because it's used within borrowing and lending. We've got asset markets, which is like NFTs. So, and there's a lot more. I've written extensively about this in Global Macro Investor and also in Real Vision Pro Macro. I've talked about this at depth too. This is a new digital economy and it's an emerging market and it's the fastest growing market we've ever seen. So that's on the crypto markets. I'm trying to think if there's anything else really to talk about in markets. Bond yields, I still think, come lower, driven by falling inflation over time and slower growth. And so I think that's fine. I'm looking down my screen, which is why I keep reaching over, see if there's anything else interesting. Banks, talk about banks, they'll eventually, the regional banks will need all of this commercial real estate being shoved off their balance sheet onto the Fed balance sheet, which will be part of the QE or whatever they call it this time around. They'll find a different terminology to stuff onto their balance sheet to pay the interest on the debts so they can roll the debt because there's far too much debt and that all has to come in 2024, 2025, which is why the whole stimulus machine starts coming and Papa Powell will do his best to appease his overlord, who's Janet Yellen. These are not independent creatures anymore. They're all trying to do the same thing, which is manage this gigantic debt burden and also the baby boomer savings complex because they can't let that go bust. To the detriment of anybody younger. Save the old people, save the financial system, save the government borrowing. Everybody else can fend for themselves. Lovely world we live in. That's all part of the everything code thesis and the exponential age.
In this discussion, Pal confronts the looming elephant in the room, the substantial debt burden hanging over the economy. He openly explores the strategies employed by central banks and governments to navigate this debt, emphasizing the delicate balancing act required. This involves supporting the savings complex of the baby boomer generation while averting a financial collapse that could disproportionately impact younger generations. Pal points out the stagnation resulting from a lack of economic recovery, setting the stage for a potential weakening of the dollar and the subsequent ascent of emerging markets. He singles out India as a notable player in this arena, although it still trails behind powerhouses like the Nasdaq and the crypto market. Let's now delve into his insights on these dynamics.
It's a singularity event for economies as well as humanity. And I think it might change economies first. I don't know what businesses even survive, what new businesses are, what the business models are. I know nothing. And that's an honest answer. So I do know we've got 1 or 2 cycles left of the everything code, because we can't avoid the everything code because nobody can pay the debts, and in which case the whole system collapses, which they won't do because the baby boomers need to retire and they're trying to support the baby boomers savings complex and the government itself. They can't raise taxes to pay for the bills because nobody's got any money, and politics are too fragile right now to raise taxes. So they just clip the coins instead, which is debasement of currency. And there's only 2 assets that outperform the debasement of currency. And I've talked about this ad infinitum. And that is technology stocks and crypto. And crypto is the fastest horse in the race. And now, why don't fuck this up is because neither of those 2 assets are particularly easy to own because they're volatile. They want and people hate them. People whisper in your ear all day long. They mock you on Twitter. They tell you you're stupid. You shouldn't do this. You shouldn't do this. Buy my value investing stock. You should buy the Russell 2000. You should diversify, my friend. And meanwhile, we've got probably 2 cycles less. 2 cycles less left to not fuck this up. Again, apologize for all the swearing, but this is actually important. I'm planning on something to get you over here, so just shut up. I'm looking after you, don't worry. Frank Anthony, Raoul, have you considered putting the bond trade back on? No, because I've now come round to the fact that everything is a suboptimal expression of the same trade. And the trade is liquidity, and the optimal expression is crypto and technology. I would rather put risk capital into that trade than the bond trade. And, a lot is priced into the bond market, so I just don't think it's as attractive. I just think, what do I rather do? Make a decent, rally, 30, 40% rally in the bond market and go, well, that's great. 30% rally, let's say. Unbelievably good year in bonds. Versus 5x in Solana or whatever it'll do next year. 10x. Oh, I did 10x last year. Whatever. It's just like, none of it compares. Just none of it compares. So I just don't do it. I will let you know if I think it's a good trade. Won't mean that I will do it.
European workers are optimistic that the upcoming pay round will help restore incomes eroded by higher prices. However, the expected boost to their purchasing power poses a challenge for the European Central Bank in its efforts to combat inflation and bring it back to the target. The ECB identifies wages as the single biggest risk to its inflation-fighting mission, projecting a salary growth of 4.6% across the Eurozone this year, well above the 3% pace considered consistent with a 2% inflation target. Raymond Lydon, an economist at the Central Bank of Ireland and a contributor to the popular Indeed wage tracker, acknowledges the potential for a bumpy road to 3% wage growth. He notes that pay hikes increase costs for firms and boost household income, factors that could drive up prices, compelling the ECB to maintain higher interest rates. Unions see a combination of gradually cooling inflation, low unemployment, and robust corporate profit margins as their best opportunity in this economic cycle to restore workers' living standards, especially after a 5% drop in real wages from 2022 to 2023. Workers, emboldened by decades of labor losing leverage, are ready to challenge corporate giants like Tesla and Amazon, both already facing strikes in Europe. The lack of real-time wage data for the 20-country Eurozone makes the Indeed wage tracker, measuring salaries advertised on the website, a crucial indicator for the ECB to anticipate future trends. Despite wage militancy potentially strengthening unions' bargaining positions, there's a concern that it could backfire if the ECB decides to keep interest rates higher to curb demand, fearing a wage price spiral or economic overheating. Share your thoughts on the parallels between the interoperability of the digital world and the current macroeconomic landscape in the comments section below. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.